Good evening, everyone. My name is Waqar Ahmed. I'm the Group Finance Director here at L&Q, and I've been at L&Q 26 years now. So pretty much most of my working life has been at L&Q. And it's quite a challenging year this year on finance. And, you've all read about it in the news and you've seen what's going on in the UK. We are no different to any other organisation or any other person. We are affected by some of the issues that we are all facing. So the bad news is I've got about 10 minutes, I've been told, to talk about L&Q's finances. The good news is I don't have any slides because I don't want to, bore you with death by presentation. And we'll just have a 10-minute chat about our finances. So every year we set the budget, and this year we set the budget £1 billion of income that we're expecting, 600 million from our rent roll, and around 400 million from sales, whether it's shared ownership sales or sale of new build properties. But when we set our expenditure, so how much money do we spend on maintenance? How much money do we spend on planned maintenance? How much money do we spend on other parts of our business, like community investment, our management costs, etc.? All of that has to be done with three things in mind. Firstly, you, our residents, we need to make sure that we're providing you with the best service that we can. We need to make sure that we're investing in communities. So that's the first thing we've got to balance. The second is, of course, our lenders. So we have a loan book of 6 billion. And the problem with lenders is, the nice thing about lenders is they give you cash. The bad thing is they want in return interest, and they want covenants. And by covenants, these are conditions that we have to comply with in order to make sure that we're in charge of the business and not them. So if you imagine breaching one of your covenants is the equivalent of having your home repossessed, and that's something that we just can't allow in L&Q. Not only do we need to make sure that we stay within covenants, we need our lenders on our side. So if we've got lenders on our side, that means each year we can borrow more money to fund development, and that's always something we've done in the past. The third area is, of course, our regulator. We are part of a regulated sector, and we need to make sure that everything we do gets the support and confidence of our regulator. And that's really important to L&Q, to make sure that we are a long-term sustainable business. So with those three elements in mind, that's how the budget is set. So this year we set a budget to spend around, as David said, we've got the largest ever maintenance program that we've ever had. We're spending over 300 million on maintenance. This year we were looking to spend over £1 billion on development and to complete around 3,000 homes this year for people who need affordable and social housing in the future. We also know with a 6 billion loan book, our interest rates have gone up. Only 2 years ago, interest rates were around 2-3%, and now they're at 5-6%. So our interest bill is now around 250 million. So it's quite a lot of numbers there. But the key message there is, with that level of income, with that level of costs, we were expecting to make a surplus. That surplus gives our investors confidence in L&Q. It makes sure that we meet all our covenants with our banks. And then that money, that surplus, can be used in the following year to carry on either putting more money into long-term plan maintenance or in development. And what we're moving towards is more money for maintenance. So that was the plan. So how did this year go? Well, we're kind of halfway through this year, and I must say it's been the most challenging year we've seen. We're still seeing high inflation. So all our suppliers, whether they work in maintenance, whether they work in development, they're just asking for more money for their labour, for their time, for materials. And that's just where inflation is at the moment. So we're seeing further bad news, just because we're operating in a higher inflation environment. The cost of living crisis hits L&Q just as much as it hits our residents, just as much as it hits our staff. The other area is interest rates. So we assumed, as we were advised by many economists and banks and in all the global investors in the world, and the Bank of England themselves said, this is it won't go any higher, but it did. And as a result, this year we're expecting our interest rate bill to go up by another 15-20 million a year. So it's quite a challenging year for us. As a result of higher interest rates, it's harder now for people to get a mortgage. And we are looking to sell something like 2,000 shared ownership homes every year. And for a lot of those customers now, it's just difficult to buy whatever share they wanted to buy. So some are buying smaller shares. It's taking longer. So we're achieving less sales than we expected. That means less profit that we than what we set in the budget, and it also means less cash coming into L&Q. So quite bad news on our sales, possibly as bad as 35-40 million than what we assumed. We're also, in addition to the 15 million increase in interest rates, that's a quite a big loss that we're going to have to think about this year. We're also seeing higher demand for reactive maintenance. So on maintenance, for example, we've allowed in total over around 100 million for reactive, and then the rest for planned and other areas. But of course, that 100 million, there's demand that could push that figure up to 25-30 million above what we've assumed in the budget. So again, that's pressure on L&Q. And what we can't just leave it at that, because if we don't meet our covenants, it would put L&Q at risk, and it puts our entire plans for future at risk as well. So what are we doing about that? Well, firstly, we know that the sales market has slowed down, so we are looking to dispose of some stock to other housing associations. We're looking to sell off some void properties that are just not viable and not worth keeping. We have slowed down the development program. So we have, whilst we didn't want to do this, we'd much rather build homes because there is a housing crisis, but we've had no choice. So we have had to slow down the development program by about 500 million over 3 years. Also, on the interest bill, we've renegotiated some of our loans that were expensive. We are trying to manage cash differently. We've renegotiated covenants with banks, so we've got better covenants so that we can just manage this difficult period. And I'm pleased to say that we've been quite successful in doing that. And on maintenance or on planned maintenance, there is some improvements and efficiencies. And David mentioned earlier on that we're not happy sometimes with the way our contractors are charging us, and we're looking at how we can get better value for money out of those contractors. We're also looking at some works that could be moved into the first quarter of next year rather than in that last quarter of this year. So there's stuff that we're doing in planned maintenance that will help ensure that we stay. We will spend more on maintenance. We'll probably, we budgeted around 300 million. We're going to spend more, but not quite as high as perhaps we first thought. So a number of things we're doing this year to make sure that whilst we may not hit the budget, but we will make enough, we'll deliver enough of the financial ratios that our credit rating agencies and our banks and investors and the government, the regulator, all look at L&Q and how they monitor us. So that kind of helps with this year. But then what about, what about next year? Is that going to get better? Well, it's unlikely interest rates will come down much. It's unlikely that there is expectation inflation will come down, but it's unlikely it will be significant. And we know we've got increased pressure to spend more on maintenance, and we want to spend more on planned maintenance as well. So we know next year is not going to get any easier than this year. So there are some things that we are looking to do. The first thing is, of course, we are looking to move out of certain business areas that we've started for very good reasons many years ago. So we started, for example, investing in a land company in the Midlands with a view of building 50,000 homes over a 10-year period. We're not likely to do that. We're going to let other organisations do that. So we're looking to sell our interest in our land company in the Midlands. That generates 200 million of cash. That 200 million of cash can reduce our debt, which reduces our interest bill, which means we can put more money into maintenance. And that's the exact reason why we're doing it. We're also looking at ways of getting investors into L&Q. So at the moment, our business is entirely driven by, or funded, rather by either our own profits that we've made over the years, government grant, or debt. That's how L&Q has been funded. But we're looking for ways now to see how we can bring equity into L&Q's business. So we've got a PRS portfolio, for example, a separate company that runs our market rent properties, and we've got about £1 billion of stock in that PRS company. I'm the exec lead to oversee that company. We are looking, how can we dispose of our interest to other investors? So, the residents still get the same service. We still provide the same homes, but it's just not our money, it's somebody else's money. And if that generates $1 billion, it means we can reduce our debt. And again, that reduces our interest bill, which enables us to invest more into planned maintenance. So, and then the third area we're looking to do is also how can we fund development differently in the future? If we do nothing, we'll slow down significantly in development. And we don't want to do that, because whilst it's really important to provide the best service we can to our existing residents, that's absolutely understood. But we've got to think about the next generation as well. We've got to think about our future youngsters, the next generation that will be needing homes. And if we're not providing those homes, who will be? So we will be looking at ways of seeing how we can get other people's money, investors, to put some money into development. And there will be so we can build at the same pace, but we're just not using our capacity to do so. So we deliver all of that stuff next year. It will mean that, as David said earlier, we've got this 15-year plan to spend $3 billion on our existing homes, so a very ambitious target there. But we're going to ask David and his team to do it sooner and faster. So can we do it in under 10 years? That will be that will earn your confidence. It'll be that we're investing in our homes faster, quicker, making them better, and we're doing it in a much shorter period than the 15 years. Anything over and above that, any other extra capacity that we generate will go towards building more homes. But the final point I just want to say is we've got a lot of capacity in L&Q. We've got a lot of opportunities. We've got very creative people. We will do this, and we will restore L&Q back to what good looks like. The one thing that we haven't touched was the L&Q Foundation. So Matt described some of the excellent work the foundation does. And right now we know that with where cost of living is and the impact it's had on our residents, that is the one area that we should not be touching. If anything, we'd like to put more into the L&Q Foundation. So again, that is an area that we will continue to invest in, because it's not just about bricks and mortar, it's about people's lives and their life chances as well. So hopefully that's a snapshot of where we are, what we are planning to do about it, and what we'll do in the future to make sure that we continue to provide good services, continue to invest in our homes, continue to support development and growth and build more homes, and continue to support our communities.